Block. When it comes to risk, economists have a very different perspective than the rest of us. They use terms like systemic and systematic in their communication. They separate market risk from liquidity risk from reinvestment risk. As a member of the general public who is diligently putting money away for retirement, you probably think of risk in more concrete terms, such as the risk of losing money or the risk of making poor decisions regarding investments. Today we'll talk about 4 real risks of investing in this video. Watch the full video to know about them and subscribe to channel for more videos. Let's take a more in-depth look at 4 potential risks that a new investor may face in the real world, as well as offers suggestions for mitigating those risks. Number 1. Your securities could lose value when you need to liquidate. At some time, your investments will lose value. You should get used to the idea that stock prices can go up and down at any time because there is nothing that can be done to stop it. Keep in mind that the value of your investments on the day that you will need to liquidate them will be of the utmost importance. Any drop in the value of your stock that occurs 20 years before the company is liquidated is typically irrelevant. Imagine that tomorrow one of the stocks you own suffers a 10% loss in value. If the drop was caused by an event that is only temporary, then your stock price should eventually recover. The decline in value is irrelevant if you wait for the stock to recover and then sell it for a substantial profit. This would make up for the loss in value. The other possible outcome of this scenario is not as desirable as the first. Imagine that you just retired today and the stock market experiences a 10% drop the following day. It is possible that you may need to sell this stock at a loss in order to meet the financial obligations associated with your retirement. The fall in value is an essential consideration in this context. After a drop in the stock market, there are 2 strategies that can be utilized to avoid selling investments at a loss. 1. Keep a large quantity of cash set up for use in case of an emergency. A balance that is adequate to cover your expenses for 3 to 6 months, or even longer if you are getting close to retirement, should be one of your goals. Before you begin selling stocks, you will have a cushion in your finances thanks to this. 2. Do not invest money that you plan to spend within the next 5 years. This is bad investment advice. Then you should have enough time to ride out any storms that the market throws your way. Number 2. Your portfolio could underperform over time. It is possible that your investment portfolio may perform poorly over time. Investors with expertise focus their efforts on achieving success over the long term. This is as a result of the unpredictability that exists in the activities of short-term markets. The challenge lies in the fact that it is difficult to forecast long-term performance from one year to the next. After 15 years of implementing your savings plan, there is a possibility that you may discover you are not quite as far along as you should be. This may give you reason for concern, or even worse, it may force you to delay your retirement. Utilizing the following 3 strategies can help you avoid becoming dissatisfied with the success of your long-term investments. 1. Maintain realistic anticipations regarding your progress. Following adjustment for the effects of inflation, the long-term average growth rate of the stock market is approximately 7%. Use a benchmark of 7% if a significant portion of your investment portfolio is comprised of equity investments. If you minimize your exposure to stocks, you should get used to a slower pace of growth. 2. Adhere to the best practices for asset allocation based on your age. By subtracting your age from 110, you can calculate the percentage of stock you ought to hold in your portfolio. If you followed this general rule of thumb, by the time you were 45 years old, your investment portfolio would have consisted of 65% stocks and 35% bonds and cash. This strategy makes expansion possible while minimizing the associated danger. 3. At a minimum of once per year, evaluate the performance of your portfolio in relation to the behavior of the market. In the event that the market suffers a loss of 15% in a given year, the value of your retirement account will not rise. On the other hand, if the value of the market goes up by 15% but the value of your account goes down, you are failing and may need to make some adjustments. If you haven't subscribed to our channel, please click on the subscribe button if you want to hear more from us. Number 3. You could get overconfident. It is possible that you are feeling arrogant. When the market is performing well, many investors become overconfident. Overconfidence can easily persuade you to make rash purchasing decisions, spend more money than you should, and focus on making short-term gains. The stock market, on the other hand, may rapidly shift from strength to weakness. When something like this happens, overconfident investors may suffer the most. They risk keeping non-essential losses in their portfolios and becoming overextended as a result. Worse, these losses could have been incurred on equities with little long-term potential and were purchased with the intention of making a quick profit. Having a firm grasp on your investment strategy is the first step toward establishing yourself as a knowledgeable investor. Your strategy takes into consideration your objectives, schedule, trading frequency, and preferred firms. After you have done creating these qualities, you will be able to examine the reasons for each transaction. Consider if the offer fits with your broader strategy. If it doesn't, keep going without turning around. Number 4. You might lose confidence. Your financial well-being might suffer just as much from a lack of confidence as it would from an abundance of it. In a market that is falling, you absolutely need to have trust that it will eventually rebound. If you do not have this guarantee, you may as well sell all of your possessions and bury yourself in cash. That is a classic example of a bad choice. Researching previous instances of stock market recoveries can help you keep your confidence level high. During the course of the last century, investors have suffered through a number of different catastrophes, including the Great Depression, the Great Recession, an oil crisis, stagflation, a technological bubble, and a pandemic. The market tends to bounce back eventually. If you have faith that this pattern will continue, it will be much easier for you to keep your cool in the face of the next significant crisis that happens. Make use of these useful strategies as a kind of insurance against the possibility of a lack of liquidity, an unattractive portfolio, and the mistakes that may arise from either an excessive or inadequate amount of confidence. In addition, you may talk about your approach at social occasions like cocktail hours without coming out as an economist. Share your thoughts on this video in the comments down below. If you found this video helpful, then give it a thumbs up and don't forget to subscribe to our channel before leaving.